Good afternoon, everybody, and thank you for joining us here for our webinar on where the housing market is and where we're headed. We're going to give folks just a couple more minutes to join, so I'll be back with you in just a few minutes. Good afternoon, everyone. I'm Dr. Lisa Sturtevant, Chief Economist with Bright MLS. I want to welcome you to today's webinar, where we're going to have a housing market update. We have a great crowd joining us today. I see that we have over 100. Oh, we're up to 120 people. So as people are joining in, I just wanted to let you know that we are recording this webinar, and the recording will be available on the website, on our website, so you'll be able to rewatch the webinar, share it with colleagues, share it with clients, make it available if you know folks who have missed it. We're going to be doing these monthly webinars the third Thursday of each month, where we will recap where the housing market's been and maybe talk a little bit about where we're going. This is the first one for 2023, so Happy New Year, everybody. And I hope that the new year is starting off well for you. So as we get started here, let's take a look at where the Mid-Atlantic housing market has been over the last few months. We know that 2022 was a really interesting year for the housing market. The first half of the year started off really busy, really frenzied, very fast home price growth, a lot of people in the market. And then the second half of the year, the market really did an about face where home sales activity slowed dramatically. Sellers were even holding back and price growth started to really moderate. So while 2022 started out with a bang, we really ended with a whimper here. And this chart shows the number of home sales in a given month compared to the same month a year ago. In December, home sales were down 38.4% compared to where we were last December. That's for the whole Bright footprint. You can see the variation a little bit across our three major metro areas, but really across the board, home sales activity was down significantly compared to where we've been a year ago. And you can see that this year-over-year decline in home sales activity really started to escalate in May and June and July of this past year, which not surprisingly corresponds to the period in which inflation started really escalating, when mortgage rates started rising really quickly, and where frankly affordability was a bigger constraint on home buyers, and many buyers were just simply being priced out of the market. At the end of the year, we're still seeing the impact of higher mortgage rates on buyer traffic, but we're also saw a little bit, I think, of just a kind of wait and see mentality. Mortgage rates hit past 7% in November. Then we had Thanksgiving and the winter holidays. And so as we're sort of tracking this, we're seeing maybe both buyers and sellers were just sort of waiting to put 2022 in the rearview mirror, looking ahead to 2023. We know that as buyer traffic has slowed down, as mortgage rates have reduced purchasing power, we have seen home price appreciation slow considerably across the Bright footprint. This chart shows the change in the median sales price in 1 month compared to the same month a year ago. Look back in 2020, you can see home prices were up 12%, 14%, sort of double-digit price growth really for the last couple of years. But over the last several months, we've seen the rate of home price appreciation drop dramatically. In most regions, home prices are still up compared to where they were a year ago. The big exception is the Washington, D.C. metro. For the first time since we've been tracking this since the pandemic here, we've seen that the median sales price in the Washington metro area was actually down 1.3% compared to where we were last year. Part of that really has to do with the fact that the Washington area is a higher priced market, affordability is a bigger challenge, and prices have then been resetting faster than in some other markets. You might start to hear more and more talk about home prices falling, and the media are reporting out on prices coming down. And it's I think really important to pay attention to what exactly they're talking about. Prices have come down from peak levels, right? The peak home price in our region was during the summer. Home prices do tend to peak in the summer. And so then in the fall and the winter, we actually see the median price each month kind of come down a little bit. So part of this trend is sort of seeing home prices come down from the peak. That's sort of a typical seasonal pattern, but we're actually seeing a faster decline in prices from the peak than we would in a typical year. But year over year, right, sort of annual price appreciation, you can see prices are still up nearly 5% year over year in the Philadelphia market, up 3.6% in the Baltimore market. Places that are a little bit more resilient because prices are a little bit lower and affordability is a little bit better. Another big change we've seen in the market is that inventory is starting to increase. So these bars show the change in the number of active listings at the end of a month compared to the same month a year earlier. Look at all those negative bars, right? All the ones below zero, where every month we were seeing inventory and supply shrinking until we were down to, talking about inventory in terms of days of supply as opposed to months of supply. For the last few months, we've started to see that year over year, supply in the market is increasing. But it's not because we're seeing a lot of new listings coming onto the market, but rather that pullback in buyer activity is causing homes to linger on the market longer. And so as they stay on the market longer, inventory is beginning to build up. Across the Bright footprint, supply is up about 29% compared to where we were last year at this time, and really up in all markets across the region. What I will say is that when you look at the inventory levels in terms of months of supply, we're still at about 1.5 months of supply in many markets, under a month's supply. So it's still a tight market in terms of inventory. It's just we were coming from such a historically low level of supply that this increase we're seeing is really notable. However, buyers who remain in the market now, who decided not to sit out, frankly, are still finding it a little bit competitive. They're still finding that while they have more leverage on prices and more ability to ask sellers for concessions, and certainly for home inspections and appraisals, there's inventory still really low. So buyers are finding that they have to act when they find a home that they're interested in. As we look ahead, we're trying to sort of gauge where home sales activity is going. And I think my read on this is that we have bottomed out in terms of demand. We started to see mortgage rates fall. So again, mortgage rates came down again this week. Mortgage rates are now lower than they've been since September. And so I think some of those buyers who have been waiting on the sidelines in the last quarter of 2022 are going to show up in the market here as we head into the first quarter of 2023 and into the spring. But in December, the number of new pending sales, number of homes going under contract, was down 31.8% compared to a year earlier, down across our major metro areas. And in fact, we saw pending sales activity lower than it has been in more than 2 decades in some local markets, really sort of historically low. The interesting thing, though, is the market is shrinking on both sides of the equation. We hear a lot about buyer traffic sort of slowing down, but there's also been a pullback on the seller side. So we've seen historically low numbers of new listings coming on in the market. And so that sort of has just reset the market to kind of a smaller overall market where it still does remain competitive for some buyers. This is that new listing story, right? So the number of new listings that came on the market in December was down 25.9% compared to last December. And every month you can see new listings was lower than we saw a year ago. You know, part of that is homeowners are not incentivized to move if they are holding a sub 3% mortgage. It would take a lot for them to sell their house and then have to move into a mortgage rate that was more than double that. And we also know that most home sellers are also prospective buyers. And so folks are still looking around at the market and finding it pretty tight and finding inventory pretty low. So it's a little bit of a self-reinforcing cycle. Typically, we see new listings begin to ramp up in the first quarter of the year in anticipation of the spring market. I think it's going to be interesting to watch. This would be the number that I would watch, these new listings numbers, because I think we're going to find that buyers are going to lead the sellers this year. Usually it's the other way around. We usually see new listings begin to ramp up and then buyers' traffic showings start to increase. But I think as mortgage rates sort of settle into their new normal around 6%, I think buyer activity is going to be pretty relatively busy, and supply, like I mentioned, is still going to be pretty limited. We have seen kind of a reverting to typical in terms of how long it takes properties to sell, and I think that's a good thing for home buyers. It's a good thing for the housing market. Buyers are able to take some time thinking about the decision. They're able to possibly see multiple properties. But we have seen this median days on market rise pretty quickly here over the last few months. In December, the typical home sold in the Bright MLS footprint was on the market 18 days. That sounds pretty quick to me, but that's 7 days longer than it took a year ago. And for example, you can see in the DC area, for example, homes are taking typically 3 weeks, 22 days to sell. Again, sounds pretty quick, but that's 10 days faster than it was, 10 days slower than it was a year ago. If you look at this chart, though, you can see that the median days on market, which is hovering around 18 right now, is still lower than where we were back in 2018 or 2019, where in our region, homes would typically take between 20 and 30 days to sell. And so all of this is to say that, we in the second half of 2022 really saw an about face in the housing market. The housing market then is now, I'm calling it sort of in a resetting phase. And this is really an opportunity now that folks are going to have to be a little bit re-educated about what a more typical housing market looks like, that homes staying on the market 20 days is not unusual, and that buyers being able to take a little bit of time thinking about the decision is not unusual. And buyers and sellers negotiating during the transaction is not unusual. So all that is last year, and now we're looking ahead to this year and trying to understand where the housing market might be headed. A lot of people are really interested in where mortgage rates are going, because they ran up so quickly during the last year. This orange line on this chart shows the average rate on a 30-year fixed rate mortgage. And look, you can see just how quickly that rate increased from the beginning of 2022 up until here, the end of the year, that average rate more than doubling. So while mortgage rates are sitting now around 6 to 6.5%, and you can say, well, that's not high relative to where rates have been historically. That's true, but mortgage rates ran up more quickly last year than they have in history. And at the same time, we've seen home prices running up very quickly. And so this has had sort of this double whammy on prospective buyers and really jacking up the typical monthly payment that buyers are facing. a big part of the reason we saw mortgage rates rise was because the Federal Reserve was targeting that short-term federal funds rate. That's the lower line there, the light blue line. The Federal Reserve is raising the short-term federal funds rate in order to try and tackle inflation. And there's been some good news on that front. Inflation came in at 6.5% in December, which is a steady decrease from the 9.1% we had earlier this summer. So there's some evidence that those Federal Reserve rate increases are having the intended effect of bringing inflation down. And at the same time, we've seen that labor market conditions have been pretty stable. The unemployment rate is staying low. The number of new jobs being created is still pretty high. And despite some kind of high-profile headlines about some layoffs at tech companies, overall, the labor market is still really resilient. All that is to say is I expect that the Federal Reserve has committed to continuing to raise interest rates here in 2023, but we should expect to see that those rate hikes will be less aggressive moving into the year, and that they may be able to slow their rate hike program earlier than they expected. And then that would allow the economy to be able to operate on its own and allow mortgage rates to then settle back into what I think is going to be around 6%. You know, a lot of the rate hikes from the Federal Reserve have been very well telegraphed publicly. And so the mortgage rates we're seeing have baked in a lot of those increases that are expected. The thing that I would watch if you wanted to try and gauge where mortgage rates are headed is that middle dark blue line, and that's the yield on the 10-year Treasury. And that line and the mortgage rate line tend to move very closely together. But notice the gap between those two lines is much bigger than not much bigger, but it's bigger than it was back in 2018 and 2019. And in fact, if that gap between the mortgage rates and the 10-year Treasury yield was at its historic average, mortgage rates would be 5.3% instead of 6.3%. So all that's to say is there was room for mortgage rates to come down, even if the Federal Reserve continues to raise the short-term rate because of that link to the other part of the economy. So I would watch what happens to the yield on the 10-year Treasury. You can track that every day if you want. But the bigger, I think, takeaway is that we're still seeing a lot of variability in rates and terms across lenders. And so buyers should definitely be shopping around and seeing what kind of, rates and terms are available, and be ready to act if they do see mortgage rates come down. As we look ahead, we talk a lot about mortgage rates. We have to, right? We talk a lot about inflation. We have to. We hear about those things in the news every day. Those are the things that make us take pause and wonder if the housing market might be weak in 2023. But there are a lot of reasons to think as the market resets that the underlying fundamentals of the market remain relatively strong. So as the market kind of resets in 2023, we have to keep in mind that the demographic and economic fundamentals are very positive. So we have strong demand from the millennial population, which is now between the ages of 27 and 42. The median age of a first-time buyer is 33. And so kind of if you think about that, 27, 42, 33, we have a population of would-be first-time home buyers who are going to be in the market here for the next, 3, 5, 7 years. And while they're facing certainly some challenges, which I'll talk about in just a minute, they are eager to buy, and in some cases have had to hold on as rates increase during the fall and may be ready to return to the market this spring. So that's that pent-up demand of people sort of sitting on the sidelines. And I do think that we are kind of in this period of accepting this new normal market, right? As I mentioned, 6% mortgage rates are not that unusual, but they certainly are different from what we've had over the last couple of years. And the fact that, sellers are having to rethink pricing their home to reflect current market conditions instead of the market that we were seeing back last year or the year before, and working with a real estate professional who understands local market conditions is, sort of more important than ever. And those of us in the industry can now be a resource to folks who want to be able to talk with people about what's going on in the market. There are risks in the market, and just affordability is a big one, right? So there is just been this tremendous increase in home prices. At the same time, mortgage rates are higher, and it's frankly just made it so the numbers don't work for everyone. At the same time, though, we've seen that existing homeowners have accrued record levels of housing equity. And so for those who are repeat buyers, they're able to kind of, turn over this equity into the purchase of a new home, and in essence, sort of buy down the higher rate. First-time home buyers are facing the greatest challenges, and that will likely continue into 2023. Inventory is still going to remain relatively low. New construction, which has really ground to a halt during the fall, is I think likely to begin to ramp up in the spring as the demand comes back. It's really interesting. We've seen home builders stop building, slow down on new construction, and there's a lot of offering to buy down mortgage rates or to offer amenities on the houses. But builders aren't really dropping prices, and that tells me that they expect that the market is going to rebound in the spring, and they don't want to have dropped prices to a point that's where they have to, start pricing at when the market comes back in the spring. Some of the other risks in the market are some local markets that really were really booming during the pandemic, the so-called Zoom towns, where people moved out of major metro areas to some of the more far-flung suburban communities, or to some rural communities, second home markets, vacation markets. These are the places where that sort of surge in demand during COVID will start to see a settling back into a condition that has to kind of reflect more local economic conditions. So I would say that, if we're thinking about where prices might actually fall year over year, it's these places where affordability is a big challenge, but then it's also places where the market was really hot during the pandemic and now has sort of returned back to more normal. The last thing I'll say, and it sort of touches on this affordability and first-time homebuyer issue, is the fact that, we've seen during the pandemic that inequality in the labor market, in the housing market, has really been highlighted. And that's going to be true in many ways in the housing market in 2023. Folks who own a home are continuing to hold high levels of equity. People who are trying to get into home ownership are going to have a really hard time. And the solution really is for us to see more new supply coming online. But I don't see that happening in any significant way in the near term, as existing homeowners are sitting tight on their low mortgage rates and builders are being very cautious to bring new construction online. So again, the overall message is that there are strong fundamentals in the market, that there's been a lot of sort of whiplash in the market over the last 6 months, but the fundamentals should drive pretty stable conditions in 2023 in the Mid-Atlantic market. There is a lot of variation across the country, but in our market, we're a pretty stable housing market. And so in November, I put together a forecast of housing market conditions for our region. And so the light blue 2022 and 2023, and then you can look at the orange columns are sort of the change year over year. Here in our market, expecting that the number of home sales will be down 4.6% in 2023 compared to 2022. So think about that. That means we had a big pullback at the end of 2022. 2023 is going to be lower than 2022. And one of the reasons for that is we saw that a lot of purchases that might have been happening in 2023 actually got moved forward to take advantage of those low mortgage rates. And so there's also going to be people who are out there looking, still finding relatively limited supply. So supply is still going to be a constraint. So this is really a resetting market, right? So it was like a pendulum. We went this way in terms of sales, and now we have to come back the other way before we settle back into a more typical pattern of home sales transactions. And you can see across the Philly, Baltimore, and Washington area metros, the number of transactions in 2023 is expected to be lower than in 2022. On home prices, there's the expectation that prices are falling from peak levels. There is a likelihood that we'll see median home prices reported each month for the next couple months be down below where they were this past summer. And as I mentioned, median prices were down year over year in the Washington area. We'll see some of those isolated year over year price declines. But overall, I expect that home prices are going to remain pretty steady in the Mid-Atlantic housing market, with prices up about 1% year over year. Again, much, much lower than where we were before. Typically, home prices, in an average year, who knows what average is anymore, but in a typical year, home prices were rising between 3 and 5% annually. So we're probably going to get back to that level, but not this year because of the kind of high prices we were at and those rates remaining around 6%. As I mentioned, there's going to be a lot of variability across local markets. And I sort of took a look at those counties where inventory was rising really quickly, where home prices escalated faster than in other markets. And then in markets that are really second home or vacation markets, or these so-called Zoom towns where people moved out in unusually high numbers during the pandemic, those are the places where there's the greater risk for year-over-year price declines. Places like Sussex County, Delaware, which, the coastal communities, or you have, Fauquier County out in North Central Virginia, which really boomed during the pandemic. But the core areas of the Philadelphia, Baltimore, and Washington areas are, I think, going to be pretty stable. We're a pretty vanilla housing market, and in this case, that will serve us well as we move through this transition period. I see there's a couple of comments in the Q&A, and they seem to all be related to, 3 out of the 4 of them are about the presentation and getting copies. So the recording will be available online along with the PowerPoint. So please do use these slides if you find any of them helpful, print them out, post them to your social media, use them on your website, whatever you find helpful. That is definitely what we want you to do with them. So we'll be posting them in the next 24 hours or so. There's a question about the last boom in the early 2000s. Rates averaged a little over 6%. So this should seem normal, except to people who got spoiled with 3%. Absolutely right, Michael. I think it is this idea of kind of re-educating folks about about expectations about rates. The one thing I will say, and this happened a little bit in the early 2000s as well, home prices are a lot higher now than they were in most markets than they were back then. And so sort of when people have been seeing this very, very fast rise in rates, I think that's what, in some cases, what people are reacting to. But yeah, I do think that it is just sort of resetting expectations, which will help both buyers and sellers. Yes, and please share any of this information, the recording and the PowerPoints. And so there's a question about using smart charts with clients. Can Bright MLS start incorporating closing costs in the stat so we can track who is paying closing costs? That's a great question. It's really interesting. I tried to look at, I took a look at not closing costs specifically, Tamara, but we're looking at the extent to which there were seller concessions in the transaction. And in a typical market, we were seeing like about half of sellers were paying closing costs. And during the pandemic, that fell to like less than 20%, and it's starting to go back up. So I will definitely look into that and see if that is something that we can track more regularly and include in our monthly reporting so that we understand the market a little bit better. If you have other questions after the fact, you can always reach out to me or to our market research analyst, Connor Christie. Do check out brightmls.com/research. We have monthly reports, we have weekly reports. If you like videos, we have videos. And please do tell us if there's something like was mentioned that would be helpful for us to track. We always want to make sure that we're providing the data that's helpful for you all to run your business and to serve your clients. There was a question as we're sort of wrapping up here. How many months do you think the lag is between the 10-year and the mortgage rates? That's a really good question, Mark. And it has been varying lately, because it used to be a pretty tight link between those two rates, and the lag has increased during the pandemic. And so I would expect them to move more closely together as we move into the recovery here as we head into 2023. I really want to thank you all for joining us, and please do look for our webinar next month, and all the resources that we have available on the market. And with that, I will see you all next month. Thanks so much.